This conference will now be recorded.
Well, good day, everyone. Good morning, afternoon, and evening, depending on where you are in the world. Today, we're going to have a presentation with our guest, Raef Lawson. And Raef has such a stunningly professional background. It's amazing with all his credentials. PhD, he's a fellow certified management accountant, certified in strategy and competitive analysis, chartered professional accountant, certified association executive, really impressive credentials. He's currently the executive director of Profitability Analytics Center of Excellence. And prior to this, he was vice president of research and policy for the Institute of Management Accountants, where he led global thought leadership efforts. And prior to that, he was a professor and chair of the Department of Accounting and Law at the State University of New York at Albany. He's had these wonderful senior leadership experience across diverse settings, in academia, practice, and professional associations. So that is certainly a wonderful background. And today he's going to speak with us about the Profitability Analytics Framework that they have at PACE. And PACE is the Profitability Analytics Center of Excellence. And he's going to talk about how that framework, tell us a little bit about that. But he's also going to talk about how it complements what we do with the organizational excellence framework. So with a view to how we can use these wonderful models to improve performance. And we're going to dive down a little bit deeper into, let's say, the financial area, talk about how to generate profitable revenue, invest in capital effectively, and configure and manage operations for optimum performance. So I won't say too much more about his topic. I'll let Raef take it from here. And really looking forward to your presentation today, Raef. Take it away.
Well, thank you, Dawn. It's a pleasure to be here today. It's both our organizations are uh, so interested and involved in uh, improving organizational performance, and so uh, I'm going to focus today on PACE's Profitability Analytics Framework, but I'll look at it and also organization framework and how companies and organizations can employ both to go about improving their performance. So, in terms of an agenda, I'll talk a bit about PACE, what it is, our organization. I'll talk very briefly about the organizational excellence framework, since I'm guessing many or most folks on this call are familiar with that, and then look at the PAF, Profitability Analytics Framework, and then how it relates to the OEF. And we'll have time at the end for questions and answers. Dawn will be moderating the Q&A form feature, so if there are questions you want to ask as we go along, I'm willing to answer them, or you can hold them to the end, your choice. So our Profitability Analytics Center of Excellence is an independent, nonprofit professional association, and we're dedicated to helping companies strategically manage their revenues, costs, and investments using analytical models to make better, more informed decisions and drive greater value. So that may sound very benign and fairly obvious, but it's amazing how primitive practice, and that sounds so judgmental, but it's the case, how primitive practice is in terms of the information that organizations develop to support their managerial decision making. And so we've come up with this framework is designed to guide organizations in producing that high quality information that supports internal decision making throughout the organization. And one thing I I'll emphasize now, but also later, is that we're focused on internal decision making. So our background, is in finance and accounting, and when most people hear that, they immediately think of external financial reporting, and there's accounting standards that prescribe the rules and procedures to develop that information, but we're focused on something very different. Information to support internal decision making throughout the organization. And uh, a mistake that many companies make is trying to use that external information produced for external reporting for internal decision making. And it's often uh, not supportive of good decision making, and also can actually lead to uh, poor decision making. So more information about PACE is available at our website, profitability-analytics.org, and on our LinkedIn page. Just a little bit more about PACE. We have a wide variety of free resources that are available on our website. We have podcasts, blogs, webcasts, etc. We have case studies, white papers, and special interest groups. So I'm not going to spend any more time on this, but there's a whole host of free resources that if you find this presentation of interest, please check out our website. So just to level set, what is the Organizational Excellence Framework? It has three components. There's an inner ring that describes the uh, principles for organizational culture, uh, and I believe there's 9 of those. There's the middle ring, which are the management areas that comprise of the best management practices that contribute to culture, and then the outer ring, which is focused on continuous improvement methodology and a balanced system of measurement to monitor and improve performance. So I'll just list these here and go into them in detail. So the 9 principles of the Organizational Excellence Framework are the ones listed here: leadership involvement, alignment, focus on the customer, people involvement, prevention based on process management, partnership development, continuous improvement, database decision making, and societal commitment. And there's also the 9 key management areas listed here. And again, I'll skip detailing them as I'm guessing everyone's quite familiar with those. And then how is the uh, framework implemented? It's based on an assessment. There's an automated assessment tool that uses 2 rating scales, a subjective one for principles, and an objective scale for practices. There's a teaser assessment, a full assessment, and so on. So it's a great tool to assess where an organization stands with regard to its management practices. And by benchmarking, you can see in what areas your organization needs improvement. So now let's look at PACE's framework. It's again, it's similar in the sense that it is a framework, and it's a strategic management framework. It integrates organizational strategy with operational planning. And a key aspect of it, a key feature of it, is that it employs modeling, causal modeling of an organization's markets, customers, and business environment, its resources, and so on. So it's not as many companies do when they engage in FP&A, financial planning and analysis, purely a financial model. It emphasizes the need to first have an operational understanding of an organization, and only then do we look at the financial impact of those operations. So the PAF adopts this internal decision support perspective, employ these causal-based models. And again, the goal is to provide management with realistic, forward-looking uh, analysis. It encompasses three domains: revenue management, investment management, and managerial costing. And if you think about it, when you look at return on investment, right? Typically that's uh, income divided by investment in the simplest case. And that can be restated as revenues minus costs over investment. And that's again just these three domains. And the framework looks at those in significant detail. We'll touch on some of it today, but I've tried to shy away from really doing the deep dive because that's not the purpose of today's talk. So this framework enables an organization to understand how it can generate profitable revenues, how it can invest its capital effectively in both tangible and intangible assets, and how it can manage its operations for optimal performance. So one area, that I mentioned before is that we're not looking at information provided for external financial reporting. And one deficiency of external financial reporting information is that it does not typically adequately measure and manage intangible assets. And the framework is free of those prescribed rules and says we really need to accurately, as much as possible, measure both tangible and intangible assets and manage them well. And finally, the PAF is not a method. There's a lot of methods out there. You know, uh, Lean, Six Sigma, balanced scorecard, activity-based costing, and so on and so on. And those are all fine and good and have their uses, where they're very applicable. But our Profitability Analytics Framework is a framework for applying solid internal decision support principles. And all of these methods and methodologies that I just mentioned can be employed within that framework. So we're methodology agnostic. So I just wanted to compare the value propositions of the OEF and PAF. And this is taken right from the OEF's website. It provides a validation point, illustrates the current state and desired future states, and encourages leaders and employees to see the organization as a system of interrelated and interconnected processes that must align with the mission and vision of the organization. And what about the PAF? Well, as I mentioned, it's a strategy management framework. It uses a strategy validation process to ensure that an organization's resources, processes, and plans are sufficient to implement the strategy it has formulated. And like the OEF, it emphasizes the need to understand the operations and processes of the organization. So there's a great deal of alignment, I think, between the OEF and the PAF. The difference I see is that the OEF is good for identifying uh, key areas of which an organization needs to focus, and the PF is more uh, a framework for alignment of the organization on improving its operations. So, in the last month or so, Dawn had conducted her research on some of our PF's members and followers, and did the evaluation of some respondents, survey respondents, and this is the area. This is the responses that we had in the leadership area. So we see that one area in, in terms of leadership that was in need of relatively greater improvement was in strategic planning, right? Strategic planning towards a vision and reviewing the strategic plan on a regular basis. And this is something that PACE's Profitability Analytics Framework can really help. So as I mentioned before, it's a strategic management framework, and it consists of three primary stages. The first is strategy formulation, and that's where the organization establishes its plans to identify and address its markets, how it's going to mobilize its resources, and decide what additional resources are needed. Then once it does that, we validate the strategy, and this is where a lot of organizations fall short. So in the strategy validation phase, causal models are deployed that, again, help evaluate the strategy. And by causal models, we mean just a model that incorporates cause and effect relationships. First, in terms of in operational terms, and then in monetary terms. And then finally, of course, there's strategy execution, uh, where we have decision making that employs the output of the causal models that were used to validate the strategy to hopefully pursue the organization's goals. The framework also integrates the three elements that determine the organization's profitability. So those are revenues or markets that generate revenues, the operations that drive costs, and the resources that require investment. One thing I did want to note is that while we call it the Profitability Analytics Framework, it's not solely applicable to organizations focused on profitability. So it's a framework that is meant to help organizations achieve their mission and carry out the formulate and carry out their strategy, implement their strategy. So whether an organization is a for-profit or not-for-profit, the framework is equally applicable. So the framework integrates the three stages of strategy with the three elements of profitability, uh, structured organization profits, or more generally, to achieve the organization's goals. So what does this integration look like? So now it's looking a little more complicated. Uh, so in terms of formulation of a strategy, uh, that consists of three parts. We have a market strategy that describes the current and expected conditions and opportunities in the market and how the organization is going to capture value. We have an operational strategy that describes the resources and capabilities of the organization, how they're going to align to uh, execute the market strategy. We have the investment strategy that looks at the resources that the organization has and what resources are going to be needed to implement the operational strategy. So all of all of this next stage, the strategy validation, is based, as I said before, on operational modeling. Okay, so it begins with identifying the organization's core processes. And again, this emphasis is similar to the OEF, where the understanding of the organization's processes is key. So the processes, along with potential process improvements, and again, another focus of the OEF is on process improvement. That's the third ring, right? They're modeled in operational terms based on the target KPIs. So again, in the OEF, we have an assessment of where an organization stands on various metrics. And then there's also targets. To what extent do we need an improvement? And this modeling, again, should be based on the causality principle, on cause and effect relationships. Uh, uh, Failure of many planning models is that this these relationships are not made explicit, and it's no wonder that companies have such a difficulty then in forecasting the results of their strategy and its implementation. So, with regard to uh, the work process management area, again, this is the results from the survey that we took that Dawn did on our members. Uh, One area of relatively poor performance was analyzing the processes on a regular basis. Organizations, might uh, do a high level financial performance, but don't dig down uh, enough to analyze their processes. And this causal modeling can be done uh, for both revenues and costs. So, if this is sort of a balanced scorecard approach to modeling revenues. And you see, we're doing the operational modeling first, where we're looking at training hours, which impact the number of new ideas, product ideas, which affect the number of new products developed, which in turn impact the number of new customers, the total sales volume. And then we get into once the operational modeling is done, we can get into the financial modeling again with this total sales volume and revenue. And we can do the same thing with regard to our operations and the costs that we incur. Uh, in other presentations, I just have a slide with these 8 green uh, boxes here, and I say this is a factory. Well, actually, it's 9. Okay, there's these 9 green boxes here, and say a factory, for example, wants to forecast these various costs for the coming year. How would it do that? And you might have a manager say, "Well, I think my output's going to be up 10% this year, so let's just increase it all 10%." Well, doing that ignores the operational relationships within the organization, and you can see that there's really only 2 factors that determine all of those costs. There's the number of uptime hours of the equipment and the head count. And if you know those 2 quantities and the operational relationships implicit in all of these other white boxes here, you can accurately forecast the costs that your organization is going to incur uh, in the coming period. Then once the operational modeling is done, excuse me, we do the financial modeling. Here the budget is calculated based on the forecasted volume and mix of the drivers of the process. And that could be the sales forecast, the number of labor hours, as I mentioned before, and so on. So we looked at a previous slide that had, excuse me, just 3 boxes when it came to validate strategy, but here it's broken out into 6 boxes. And why is that? This is emphasizing the need to first develop operational models with regard to revenues, costs, and investment. And then once those are developed, then to attach monetary amounts to those models. And we call that monetizing the processes and resources. And based on that, we get our revenue model, our cost model, and our financing model. So again, looking at, excuse me, the strategic management process and strategy formulation, what it would be the process organizations would follow or should follow. They'd be using some strategy method, and again, we're agnostic as to which of those is used. An organization will define and adjust its strategy and risk tolerance, formulate strategic objectives, identify strategic initiatives, and then create a balanced scorecard, or more generally, a list of KPIs, key performance indicators. And again, this is where the OEF can be very useful, where an organization can identify as a strategic objective those areas in which it wants to improve, and identify initiatives to improve, to help improve those. When it comes to strategy validation and formulation of your organization's budget, uh, it should be an integrated budget. And by that, I mean there's two streams of workload that cause the need for spending. One is demand driven, and the other is project driven. And the first of these, demand driven, are just expenses that occur from our operations. They're from our day-to-day business and our end-to-end business processes, while the project-driven ones are non-recurring and can have a widely varying duration. So if we have, for example, if we have identified initiatives to improve our performance in certain strategic uh, areas on some strategic objectives, those might be project-driven expenditures. So these project-based expenditures can include those for investments to accomplish our strategic objectives, investments to mitigate risk or maximize the opportunities organizations face, or investments for one-time projects. When it comes to our operational budgeting, again, that's based on our day-to-day operations. And again, that should be first done based on an understanding of the operations of our organizations, and then financial values should be attached to that in our financial modeling. So we would identify our core processes and potential improvements. And again, this harks back to the OEF, where we are focusing on continuous improvement. Excuse me, high pollen count today. We then model our operations and develop our operational plan and forecast our drivers. We then, based on managerial costing principles, develop a causal driver-based budget, look at the capacities that we need to implement that, and come up with our total budget for the period. I'm not going to go into this too much, but again, the key to effective modeling is causality, and that can be either strong, where the cause and effect is very clear, it can be traced, or weak, where you can only infer the relationship. Okay, so this is the problem of being in not presentation mode. Those are supposed to be hidden slides. So I want to talk for a moment about managerial costing. as opposed to cost accounting. So it starts with, excuse me, again, the causal model of the organization's resources, the information that's prepared. Again, it's for internal decision support only, and it needs to be free from the constraints and distortions of external financial reporting requirements. So uh, the consumption of resources it should not be pushed through a managerial costing model, but rather pulled by the performance of activities. And so, what do I mean by that? If you have uh, a piece of machinery, say, then you'll be perhaps depreciating it uh, over time. And typically in financial accounting, you would allocate all the cost of that depreciation to the products you produce or to your P&L. But in many cases, there is idle capacity for that resource, and the total cost of that piece of equipment, if it's underused, should not be traced or allocated to the products you produce in the period. It results in distortion of the cost of that product, and it fails to identify the idle capacity within the organization and the failure to identify perhaps an area of improvement in organizational performance. Again, we start with uh, building the operational model of the organization. We know, for example, how uh, what the capacity is of a piece of equipment to produce per hour, for example. And based on that, we can build this quantitative model, and only after then should we attach the monetary units to it. So, what are the benefits of employing a managerial costing model? Uh, in traditional cost accounting models, there's arguments over allocation of products to over allocations of products or services. If you managerial costing model where costs are pulled, not pushed to products and customers and product lines and so on, using this causal assignment, the arguments go away because it's based on cause and effect relationships. Uh, Another issue is that new production equipment is underused due to high depreciation charges on products. So that, for example, you the classic case of this,
And thank you for marking the form.
the classic case of this situation is where a company has an old piece of equipment that's been fully depreciated and a new piece of equipment that is more efficient but has a high cost and is being depreciated. Which piece of equipment would the sales manager want a given order produced on? Well, perhaps the older, fully depreciated, less efficient piece of equipment because the cost will appear to be less. But in actuality, it's more efficient, more effective to produce on the newer piece of equipment. Using uh, using the information produced for the external financial reporting system can lead to dysfunctional managerial behavior. And I won't go into it, but we advocate incorporating what we call a variable capital preservation allowance that reflects basically the replacement cost, need to replace equipment as it's used. Another issue is that selling, marketing, and administrative activities are not included in product, service, or customer cost. We need to segregate these costs. Uh, Another issue is all capacity costs are loaded onto current sales. Again, I'd mentioned that we need to isolate, separate out excess capacity excluded from the costs assigned to our current operations because it's distorting the costs that we report for our products. In the extreme case, if we produce 1 unit of our product, then all costs are loaded onto that one unit, and its costs will be many times higher than if we produce 1,000 units. So the absurdity of loading all capacity costs on current sales is pretty obvious, but also widely done, a widely followed practice. And then growth costs are often loaded onto current sales, and these are costs that are incurred to develop future markets, future sales, and so on, and they should not be loaded onto current production. So there are some fundamental modeling principles that we have in our framework. With regard to investment management, these are some of those. Only the expenditures required to preserve investment being consumed by current operations should be assigned to products currently being produced or services being provided. We talked a little bit about that just now. Sunk costs are irrelevant. If we've spent $1 million for a piece of equipment, but it's only worth $100,000 now, then what we paid for it is irrelevant. We could spend $100,000 and replace it. So again, depreciation is probably based on historical cost, and this may sound, uh, like I'm a heretic, but depreciation is irrelevant. And instead, you should look at what is the impact on the current replacement value of the products that you're being produced or services being provided. And then finally, the owner's investment in a business is not free money. We include interest expense as an expense, obviously, on our investment calculations, but we don't include any consideration of the owner's investment, and that can lead to poorly allocating that source of funds. So another key management area, of the key management areas, we see that at least in this survey that had taken, was that the worst performance was in the area of resource management. And I think we've just looked at why that is often the case. Or companies follow practices that are not supportive of good decision making, and instead are more focused on external financial reporting. So one of the big goals of PACE is to get organizations to understand the need for a separate performance management system, to use the external financial reporting system for internal reporting can lead to, again, to faulty decision making. So I had mentioned that in financial accounting, external financial reporting, there's no allocation of cost for the owner's investment in the organization. But an organization needs to understand how much of its investment is tied up in producing every product it produces, every service it provides, or servicing each customer. And so we can do that by incorporating a cost of capital into the cost structure of the business. And that includes not just the cost of borrowed capital, but the owner's investment, the cost of the owner's investment. And again, this is something that we don't see in external financial reporting. So by applying this cost of capital to the value of the resources in each activity center, will let us determine how much our overall cost of capital relates to each activity. And note that I said to the value of the resource in each of the organization's activity center, which could be different than the original cost. We want to look at how the market value of or replacement cost of the assets and apply the cost of capital to that. It's then considered a part of each activity center's total cost and included in the costing calculations. So with that, I'll wrap up my presentation. Again, I've hit just the highlights of our model, but again, its use can really help organizations formulate their strategies, validate them, which is where many organizations uh, perform poorly and execute their strategy based on the key metrics and areas of improvement that they've identified, such as with the OVF. So with that, I'll take any questions.
Thank you so much, Raef. And I'll put it out to the audience. Are there questions that anybody has? You know what really caught my attention was when you were talking about value. And, traditionally, I've thought about value when we do valuations of organizations, and you take a look at, the cost, let's say, of a business to start it up and develop it and grow it. But you take a look at that income stream as well, and then you take a look at the market potential that that business has. And so you kind of arrive at a valuation that way. But it was interesting what you said too about the not focusing on that original cost. And I'm not an accountant, but it was interesting to me that this how you distinguish that.
That is such uh, uh, an incredible area of mispractice, or whatever you would call it, in finance and accounting today. Uh, as I mentioned, companies, they focus on the depreciated value of an asset. It can be much different than its replacement value, and basing your investment decisions and your operating decisions on that erroneous information, basically misleading information, can lead to very inefficient operations.
That's very interesting. I mean, went back in the day when I was working at Deloitte and Palliser, Forrester, and KPMG. I mean, we did these valuations, of course, with someone, a financial member, on the team who had the proper certification, and that's kind of the way that we went about it. And I always thought to myself, well, it seemed to make some sense. But what I've really enjoyed about your presentation is the things that you've brought up about taking a different view of things, like between traditional kind of methods, accounting methods, and what you're doing is things like those intangible assets, an area not being covered off that well, and then being able to take a look at it properly in a lot more detail. But
That's a huge point of distinction, because
yeah,
under financial accounting, the great preponderance of intangible assets are not recorded on the balance sheet, not recorded on the
right.
financial statements. And you
Mhm.
look at the valuations on companies on the stock exchange, and over time, back in the 50s, perhaps the balance sheet approximately represented the value of the organization, the equity. But
Right.
now, you see intangible assets representing 80 or 90% of the assets of an organization. The
Yeah.
value of a company's brand, if you're looking at
Yep.
Coca-Cola or Nike or
That's right.
companies like that. And so to base uh, your financial analyses on just the accounting, external financial reporting numbers
Right.
is almost malpractice.
Well, do you
And
know, I
that's
mean, I'm thinking about intellectual property, you know?
absolutely human resources, and that's another
That's
part of the
right.
OEF, right? You
Yeah.
don't value, you're not valuing your people resources. And so again, going back to the OEF, then how do you, if you're not measuring, and again the problem accountants have is, well, it's tough to measure, but if you don't measure, you're not managing it. That's
Right.
the old sword. So how
Yeah.
can you look at how much you want to invest in people and training? That's one of your principles, practices as well. How can,
Mhm.
if you're not valuing your human resource and determining what it should be, then how can you really determine how much to invest? So again, the Profitability Analytics Framework says let's treat intangible assets the same way as tangible assets. Just do our best job in terms of measurement,
Yeah.
and so again, if we have, say we have a call center, right? Our our investment in IT is probably not negligible, but minimal
Mhm.
compared to the cost of training all of our employees there. And so if we are basing our investment decisions based on that minimal uh, cost of the tangible assets, it's unlikely that we're going to be making good operational decisions there as well.
Right. That's very interesting. And well, let's move over to Dale Weeks. He's had his hand up here for a while, and Dale's got a good background in the finance area. So I'm looking forward to your question, Dale.
Yeah, well, as Don said, I'm part of OAS. I've got a degree in finance and whatever, and been broadly involved in all of this performance excellence stuff. My question would be, since you presented the data that you've preliminarily looked at in terms of feedback and where they are, you mentioned a few items in terms of the financial community where they're strong or can get stronger in terms of improvement, but how do you move that forward? How do you get the financial community? Because I've started a lot of my work in finance and accounting, but I've broadened it into marketing and many other areas. How do you get the financial community to be one of the leaders in trying to get this broader framework? Because I find similar to IT, when you look at some of the internal components, when I worked in the public sector, we would isolate the areas of that touch the customer, but finance and IT usually don't touch the customer. How do you get finance and them to want to do more of this, measurement in terms of where they are today and where they should be in terms of their own financial metric? Just any reactions you've got?
Oh, I have so many reactions. I could spend an hour. I mean, the glib answer is I wish I had the answer. But seriously, uh, it's incumbent upon the finance profession to be involved with the rest of the organization, and that's a whole issue in terms of the future of the finance and accounting profession with the technological evolution
Yeah,
that's going on now with AI and other technologies. So much of the lower value added activities that we perform are going to be automated. Accounts payable, accounts receivable, preparation of financial statements, and so on, audited financial statements. All of that largely can be automated. So, what is the future role of the finance and accounting professional? It's what we call evolving to become a strategic business partner, being able
yeah,
to work across the organization, helping create value within your organization. And so, it's if I mean, that could be the message there, saying, you better wake up and look at what role it is that you serve within your organization, because it's not going to last very much longer. If you want to stay in this profession, you need to really have a broader view of your organization, work cross-functionally, think about value creation, and that's where the OEF comes in, as well as our other PACE framework. You need to think more strategically. How what is it your organization is trying to accomplish? How can it accomplish that? And
Yeah.
that's really core to PACE's mission. We're trying
Yeah.
to raise awareness, especially in the finance accounting profession, that there is a
Yes.
better way. Now, is that an easy mission? No, that's that's our huge source of frustration,
Excuse me.
and
Right.
so, but it's something we keep working at.
Yeah, I mean, it's the same thing you have in HR. You've probably seen the articles over the years that is HR irrelevant? Are they going to do that? And the one big thing I've had in that area has been, what you talk about ROI, the statement. People are our most important asset. Show me the data. If I'm looking at a financial statement of 20 different companies, how can I tell that somebody's got a better people asset than anybody else? You can't do it. It's been around, and there's been efforts to try and build that into the financial and accounting profession, but I don't know that it's got to where it needs to be. So if I'm want to invest in a company that has better people, there it doesn't reflect on the financial statements. At least something there that I can see. It's an intangible. It's like they've said for a long time. Tables and chairs and everything, yeah, you can get equipment measurement, but people, how do you measure the value of the people component? And that's part of what working within the excellence framework. We can give you data on employee satisfaction, we can give you data on employee engagement, but how do you translate that into a number that exists on the financial statement? So
Yeah,
this is
and no one's saying it's easy, but I mean, going back to the idea of causal modeling and that little balanced scorecard thing I did regarding to revenue. I mean,
right.
hopefully, this what is it, a process level scorecard, and that change increases operations, is training operations,
Yeah.
and so on, and the balanced scorecard basically is a series of hypotheses that you need to test, right? And what is that relationship? 5% increase in employee satisfaction. What kind of impact is that on sales?
Right.
You can probably roughly estimate it, and refine your estimates, and you but it's I've been around with activity-based costing long enough, and there's the old adage that it's better to be approximately
ABC.
right than precisely wrong. And I think
Yeah.
that's the approach you have to take.
Yeah.
You know
Yeah.
what I'm thinking about is if the work that's been done that shows the relationship between employee satisfaction contributing to customer satisfaction, contributing to
Right.
profitability, or in the case of, let's say, the public sector and let's say transit system, the tendency to refer others.
Yeah.
So there's been some good research done in that areas to show just how powerful that can
Yeah.
be,
Yeah.
those relationships. But it's it's really reinforcing here the value that each type of professional brings when they look at the organization and what's working well and what's not, and they dive down a little deeper into their own area of expertise to shed some light on results and why they might be the way they are and what to do about them, right? And I think sometimes over time in the excellence profession, I think that we've kind of left that up more to the excellence professionals, but we might run the risk of not listening to these other professionals that you might have on the management team or the leadership team. And I think too, when we do assessments, this is where it's really important to get that input from all the employees because they have their perspectives and they know about the way work is being done and how it can be done better too. And if anything, we haven't been listening enough to each other, have we? In
No,
organizations.
no, it's absolutely true. And and to your earlier point, it's so critical that every employee, every staff member understands how their work relates to the overall strategy of the organization. And if they don't understand that, then how can they go about improving their performance and suggesting how to make the organization more successful?
Absolutely.
Yeah.
Okay, anything else? We're coming to the close of the session. Any other questions? Oh, okay, with that then, thank you so much, Raef, for sharing this presentation on the work that you've been doing on the Profitability Analytics Framework and the great work that you're doing at Pace. I mean, this is eye-opening for those of us who don't work in the financial accounting area. And it reinforces for me, because that's not my area of expertise at all, that it just reinforces the need to talk with others like yourself about this sort of thing, because that view through your lens really complements everything else that we're doing and makes us that much stronger in our work with organizations. So thank you so much for your time today and a wonderful presentation.
My pleasure, and look forward to working with you in the future.
You bet.
Take care.